Hi guys, thanks for tuning in to another episode of Nuggets News, or our monthly housing and economy update with our friend Martin North. How are you today, Martin?
Pretty good, thank you. How about yourself?
Pretty good, Martin. It has been an absolutely full-on month, and it's probably going to be one of our most important ever updates. So, guys, as usual, we're going to run through all our slides about the housing market and the economy, and then we're going to talk more about the healthcare side of things that's going on at the moment. And it's important for people at home to realise that anytime we put the C word in the title, or we do say it, Martin, which we're probably going to have to say it today, YouTube does demonetize us and it won't push that video in the algorithm. So we don't normally ask you guys, but if you can share this with as many friends and family as you can, that would be really appreciated this month.
Yeah, there is a little bit of controlling messages, I think, the way I would put it. So we have to be careful about what words we use and those sorts of things.
Absolutely. Well, man, any general overview before we get into it, other than to say that the message has changed from climate change to coronavirus this month in terms of what central banks need to save us from?
Well, it's interesting, of course, because in a way we've got a baseline view now because of the latest data up to the end of last year, which we'll touch on, and then some early glimpses of January, which effectively are beginning now to be influenced by the bushfires. And potentially now that gives us a baseline off which we've got to then think about what happens if the V thing happens. Right. So that's how I think about it. So it's important to understand where the economy was before the latest issues come over the top. And then perhaps towards the end, we can speculate a little bit about what some of those forward-leading indicators may be as to where the economy could get to move to over the next 6 to 12 months.
Fantastic. Okay, so I'm just going to work my way back to the top there, Martin. And first slide today, GDP was actually a little bit better than expected, but that was the December quarter.
Yeah, so the data to the end of December was actually better than people expected. So people were thinking 0.2, 0.3. It came out at 0.5% GDP. And that essentially was interesting because there was both output was a little bit sluggish, imports and exports were both a little bit down. But the real issue here is that consumer spending, again, was very slow relative to what we've seen previously. It was down from 2% to 1.2%. And we also know that new business contracted and, there's a bunch of things going on. So in other words, it wasn't too bad. But the other point there is that the output per capita was 0.7%. Again, that's quite low. And so if you start looking at per capita data, 0.2, it's pretty low. So in other words, our baseline economy is ticking along pretty modestly. But now, of course, Treasury is saying, well, thinking about what's happening at the moment, they're taking, well, maybe half a percentage point off GDP and also another 0.2% for the bushfires. So the chances are that the next quarter or two could be negative.
Yeah, and just for people to get in that mindset, because a lot has changed since our last update. The hope and the theme was in Australia that housing prices were rebounding really rapidly, and we we're hoping that was going to create a bit of confidence and wealth effect. And the fires, the worst of that was behind us. Hopefully a bit of spending to rebuild from that, and that was kind of the hope. But things have really changed now.
Yeah, and I have to say that the latest indicators of household confidence are looking pretty bad too. So people are worried, a lot of uncertainty, and I'm also seeing some of the leading indicators relating to intention to buy property now falling off. So in other words, the property support mechanism that we have in Australia may also be on the blink too.
Yeah. Okay, so next up here we've got trade balance, and again, it wasn't too bad, $5 billion in January.
Yeah, so this is the latest data to the end of January. And again, it's surprised on the upside, 5.2. In fact, they restated the previous month slightly higher. But what's interesting is that imports and exports both moved down, right? So imports were hit by fuel and capital goods. Exports dropped by 1.2 billion. And there were significant declines in metal ores and in gold. And remember that this is predominantly before the latest events, right? So what we're actually seeing is that we're starting, as we move from January onwards, with a reasonable trade position. But it's really important to understand how that trade position is built up. And if we go to the next slide, you can see that we can look at China specifically. And what's fascinating about that is that the export goods to China are around 12.5 billion a month. And it accounts for 38.5% of total export goods, and there's also services on top of that, right? And that includes education and some other things there too. So you can see how reliant Australia is on the connection to China. And as you know, the Chinese economy has been slowing recently. And as a result of that, you've got to assume that some of that over the next 2 to 3 months is at risk. We don't know how much yet, but I think that's quite an important perspective. So we are highly leveraged to China. 38.5% of total goods exports is to China, and that is at risk.
And the numbers that we've seen come out of China just in the past week or two, the purchases, manufacturing index and car manufacturing, TVs, some of these numbers are down 90 or 95%, and that is going to hit that number very, very hard.
Well, it's interesting because we'll look at some data later, but yeah, there is definitely a slowdown. You can look at pollution levels; they're way down. You can look at some of the other metrics of movements, people movements and goods movements, and they're all down. What's interesting though is that the Shanghai Stock Index, which went down initially, is now running up. Right, and that's because the traders there are thinking that China's past the worst of it.
Yes.
Now, whether that's true or not, who knows? But even if that is true, the economic impacts of the turning off of the manufacturing systems across a lot of China is going to go on for months and months. The supply chain's already been disrupted. So you can expect to see the GDP number from China to Australia down. How much and for how long is still uncertain.
Yeah, I did a write-up on that last night in our community about that exact thing, Martin, because I think you've seen the stock markets that have bounced the highest are the ones that are more managed, whether you want to call that plunge protection team or manipulated or just the bigger stimuluses that have been announced. Australia's had a pretty weak bounce and it's been pretty underwhelming, the response from our central banking and policymakers so far. As you say, China sort of fell off the cliff a month ago and the thinking's now the number of cases has slowed down. Is the worst behind it for China? How much of that is intervention, though, remains to be seen.
Well, they've certainly done some intervention. They've taken some of the rates down, and they're talking about selective stimulus if they need to do it. And look, all the central banks around the world, of course, came out and said, yeah, we'll do whatever it takes, right? But as we'll perhaps touch on later, that may stimulate some parts of the economy, but it doesn't cure anything medically speaking.
Absolutely. All right, so government spending. I've kind of got this gut feeling, Martin, that the government have got that money there. They didn't quite get that surplus. It doesn't look like it's going to be happening anymore, but they are prepared to spend if they have to. But I just don't know why they're waiting so long and why they're so hesitant to at least jawbone, as central banks say, and give people a bit of confidence that they are going to spend a lot more and help us out.
Well, it's quite clear if you look at the GDP numbers that the consumer sector is very, very weak. Business investment is very, very weak. One of the reasons why the GDP number was quite good was because of significant government investment, and that's infrastructure investment, right? Perhaps around 25% of the economy is now being supported by government investment, and that's a big number. And if you look at the breakdown of the GDP, consumption's down. Housing is still down despite the little peak in prices recently. Exports, well, they helped a bit, but not as much. Imports, also potentially supporting a little bit. But actually, this is all about the fact, and it's not what people really fully understand, is the reason the economy is where it is and not worse is simply because the government is actually throwing a whole bunch of money through the investment channel. But the thing about the investment channel is that it takes a long time for that to flow through. So if you decide to sort of invest in road building, for example, right, there's a whole process before you actually start seeing the value come through. And my perspective now is that the government should have and needs to do something much more direct to support the economy. We can't just go through the investment channel because that takes too long. We need to find ways of actually supporting the economy more directly. And I'm particularly concerned about the small business sector because my small business surveys show that more than half of small businesses are now in cash flow issues directly related to the bushfires and related to some of the upcoming medical issues that are around at the moment, right? Put that all together, and essentially, whilst you can throw money at the, forward investments, it's not going to help them. So for me, the government's late to the party. They need to do some stuff and quickly. And I think it's true also that the so-called surplus is now just a dream, that we're never going to see that. We're never going to see a balanced budget. They need to do quite a lot more. And it's interesting that now Labour's come out and said, yeah, we'd support that if they did stuff. So I wouldn't be surprised to see some announcements very soon. But I worry that it's going to be not enough, not quickly enough, and not at sectors of the economy that can, pick it up quickly. I still think New Start should be an area where they should immediately lift New Start, because that will put money into the economy and that will perhaps get people to spend. The other point, of course, is that if people are worried about going out, and if people are worried about, what's going on, they're not going to spend that much anyway. So even if you gave them money, the question is, would that actually make a difference? And that's the other factor to bear in mind. But I think the small business sector is where some of the focus needs to be, and now.
Yeah, so I think retail is the biggest private sector employer in Australia, and that's going to be hit if people don't go out. A couple of things I wanted to add to what you said, Martin. We've touched on it before. China can build a hospital or a bridge in a week. It's going to take years for the paperwork and planning and recruitment to happen in Australia, so you're not going to get that stimulus straight away. What's the numbers, Martin, around private sector versus public employment? Is it around 90% in the private sector in terms of total people employed compared to government jobs?
Well, it's actually a little bit more in the public sector these days. So it's about 18% in the public sector, the rest in the private sector. If you think of all the hangers-on and all of the state and federal and local government. Okay. What's interesting, of course, is that wages have been stronger in the public sector versus the private sector.
The other thing I want to add to that was about your point on retail and small business. We're seeing this bond junk bond market sort of games, and people were issuing debt to buy back shares or pay off whatever they need to. Small business can't do that. They can't issue these bonds like we're seeing the big corporates do. So if they need to lay off staff, they've got cash flow issues. That means that we're going to see unemployment tick up.
Well, yeah, so small businesses for me are really where the sharp end of the pain is, right? And again, my surveys are saying that there are more small businesses struggling with cash flow, more small businesses thinking about laying people off or reducing hours. And that has a flow-on effect. There are more than 3 million small businesses across Australia employing more than 5 million Australians, right? Now, if they start having to lay people off or paying less wages, or frankly shutting down, we're seeing businesses going, falling over left, right, and centre. This cascading effect could have the most significant effects in terms of downward momentum on the GDP and on the overall economy.
Absolutely. All right, so real wages, this is something we've spoken about a lot, Martin. It's been weak compared to everything we look at, like stock market and house prices and inflation.
Yeah, so there's a lot of noise around what real wages are, but if you look at real inflation-adjusted wages, we've seen a structural change. It's a lot weaker than it was, and in a time of uncertainty, households probably will save more rather than spend more. But households are definitely feeling the pressure in terms of the income growth is just not there in real terms, despite the fact that the cost of living are rising very fast. And by the way, although the mortgage rates might be a little lower, it's not enough to offset all of the other pressures. So yeah, this is probably one of my leading indicators is what's happening to wages, because this is really telling us the full story here. Australia is in trouble, because effectively, although our wages relative to international benchmarks are quite high, there's been no growth for a very long time, and now effectively it looks like it could be going backwards.
Yes, absolutely. So that all relates to mortgage stress. This is something that we were hoping might have ticked down a bit with the rate cuts coming through, but continues to climb.
Well, we just published this yesterday. The mortgage stress data is showing a further rise. And, whilst there are some people who've got lower mortgage rates, and that's good because the rates have come down and their repayments are a bit lower, the fact is that the rest of the household budget is under severe pressure because of increased costs in other directions and the fact that wages aren't going up. So yeah, the more than 1 million in mortgage stress. I'm also worried now Tasmania's got the highest proportion of households in mortgage stress, and that's a combination of the very high house prices in parts of Tasmania, but also the very weak income growth there. We've also got large numbers of people in Western Australia who are now struggling because they've been in very negative territory for a long, long time, and that starts to then translate into defaults. But we're also now starting to see pressure in some of the other big states as well, in particularly in New South Wales and Victoria, particularly in the urban fringe and to, for example, the west of Sydney, where we've got these large estates, people bought with big mortgages, very small plots, but their wages aren't catching up with their costs, and therefore stress is right. This is a real important thing to watch. And I unfortunately think that we're going to see stress rising ahead.
Yeah, Tasmania is an interesting test case because it's that inequality that we often talk about, where we've got a lot of wealthy boomers that have accumulated assets that want to retire down to Tassie, or people that think it's too expensive in Sydney and Melbourne. But if tourism dries up and education dries up in Tasmania, we're not really seeing the wage growth, or particularly those high-paying jobs in Tasmania, to back up that really aggressive house price growth.
Yeah, it's a wicked problem, because basically you've got house prices rising very fast, but a lot of people are not seeing the income. So the income multiples in Tasmania are some of the most adverse now in the country.
All right, next up here we've got business confidence, which you already touched on, Martin. I guess it just makes sense with everything that's happened for people to be uncertain about the future.
Yeah, so this is the latest PMI, and this Purchase Management Index for Australia, and basically it shows that there's a lot of weakness. And this is before the real impact of the medical issues that are now coming up. This is partly being hit by bushfires, but what it shows is that businesses are really unable and unwilling to invest at the moment. So this is a big and important issue for us.
Yeah, and that decline now, we did have a bit of a downturn in 2013, but we're looking to see if it does turn into a GFC-style sharp, sustained decline.
Well, the question is, what are the things that businesses could do to turn this around? Basically, they've got disrupted supply chains, so many businesses are unable to get the goods and services that they need to be able to do what they want to do. They're also finding that their customers are also wrestling now with issues. So effectively, many businesses are really on the back foot. And remember that they've got cash flow. So businesses, particularly smaller businesses, actually have real cash flow issues, because if money is slowing on the input side and they've still got to spend on the output side, they get into difficulty quickly. And so expect to see cash flow issues for many businesses ahead, and that's why I think PMI will stay weak for some time.
Yeah, that's one thing I'd be interested to hear from our viewers in the comments below. I had some people reach out to say they got emails from their Chinese suppliers saying that they've got some things back in stock and they expect it to be returning in the coming weeks. And I've heard others say that they've been told, dates months in the future. So let us know what industry you're in if you're being told it's going to be a hold up or it's going to be back in stock.
And by the way, one of the really interesting areas is the construction sector, because there a lot of the raw materials came from China. And I've had in the last week 5 or 6 messages from people in the construction area saying we are out of particular products. For example, some types of boards and some type. So basically that puts construction now into the slow lane. And they're looking at probably a delay of 6 to 8 to 12 weeks before it comes back on stream again. And that's a big, big issue.
Okay, building approvals, that was hoped to be recovering and it has turned down again.
Yeah, so I always warn about the building approvals data, because the latest data, which came out recently, showed a significant fall. And the problem there is that the seasonally adjusted numbers move around a lot, because, if you have one big high-rise approval, then that's a large number of units. So that's why it's very, very variable. But what we're actually seeing is continued weakness across building approvals. Again, not surprising. That's what I expected. And so the overall message from the construction sector was, we're seeing a massive turnaround and everything's fine again now. No, the data is actually showing pretty weak. And we're going to see more weakness ahead, I think, as the broader economy begins to slow as well. So this is another, I think, important indicator of what's going
on. Credit growth, in particular, that personal credit, people trying to pay down debt, isn't it, Martin?
So the latest data from the RBA, which came out a couple of weeks ago, showed a little bit of movement, but not a lot of movement. The total housing credits at 3.1, which is pretty much at the bottom. It's moved up just very slightly. It was at 3 last time. But within that, it's all about unoccupied housing, particularly first-time buyers. Investment lending is still lower than it was a year ago. But personal credit is still lower than it was, but it's sort of going sideways a bit now. And in fact, the latest data from the last couple of months is indicating a little bit of a reduction in fall. In other words, some people are now having to reach for credit to be able to deal with some of the issues that they have. So overall, the credit numbers aren't looking very good. And by the way, business at 2.8% is also pretty weak too. And it goes back to what we said about the business sector being very weak. Therefore, they're unable to borrow. And so all of those factors suggest that whilst there are little bits of glimpses of good news in areas for some people, particularly around housing. The truth about credit is that it's definitely very slow. I don't expect it to see much growth ahead.
And are businesses likely to go into debt to pay wages, and if they think it's going to blow over, Martin, or what do you expect to happen there?
Well, one of the things I see from my small business services in particular is that they're having difficulty extending their credit. So effectively, banks at the moment are very tough on increasing overdrafts. And interesting, there was a IMF report that came out today, which said that one of the big issues that Australia has is lending by banks to the small business and medium business sector are actually not doing what they need to do. So we know that many businesses are finding it really tough to be able to get sufficient credit to be able to see them through. Now, it may well be that the government does something to support that, or maybe they speak to the banks and the banks are a little bit more flexible. But at the moment, the bottom end of credit availability for a lot of businesses, more than 1 million businesses, is not where it needs to be. If you're a larger business, if you've got other assets, or if you've got a credit rating, those sort of things, you can still get credit. But it's the smaller, medium business. And I don't see much evidence yet that the banks are really willing to change their lending criteria. And it's interesting because the IMF report said, well, what should happen is there should be a tilting away from banks lending for mortgages to lending towards the business sector. And I said, well, better late than never. But of course, the problem there is that the credit risk ratings are so skewed because of the Basel ratings ratios. It's much easier and more economic for banks to lend for mortgages. The risks are lower too, relative to the business community. So my view is that the banking system itself and the Basel rules have actually created this problem, and the banks are just following, that rule. So unless we see some changes there, many businesses will not be able to get the credit they need to see them through.
I completely agree. We've seen that in Australia over the years, the appetite for mortgages over businesses. But next up, we've got the bank's portfolio. Martin, any changes you want to highlight here?
Well, I just wanted to make the point here. This is the APRA data. Now, APRA has been messing around with this data, so it's not totally right. But I just wanted to highlight how different banks are. So this is looking at the movements of owner-occupied and investment loans over the last month, right? And you can see that CBA and Macquarie is where all the growth is. Some of the other banks, particularly NatWest and Westpac, they're actually down on their investment loans. But I also know from talking to some banks that this data is not accurately reflecting the reality for many banks' internal portfolio. So there's some translations going on between the data that the banks are putting in and what APRA is reporting. And that's one of the issues now I think we've got, where in fact we're not sure whether this data is actually telling us the full story or not. So APRA needs to explain precisely why it is that there's a gap between what the banks are actually recording internally and what APRA is reporting to the public.
Is that a case of having multiple mortgages on one property, or where do these numbers get fudged?
Well, I think some of the fudging relates to the one-to-many loan issue. So in other words, households will have multiple mortgages and APRA is reporting everything at the loan level. But the other is that the combination of movements between owner-occupied and investment loans appears to be different inside the record keeping within the banks and what APRA is actually reporting at the moment. So, there's one organisation that I was talking to that said, well, actually, APRA is saying that our investment loan portfolio grew this last month. Actually, it didn't. But because of the way that APRA is now choosing to define loans, they're actually putting some of our owner-occupied loans into the investment bucket. So there's some really funny things going on. So I'm not sure that I can trust these numbers.
Okay, something to keep an eye on as well. Home prices had been going up really aggressively. More rate cuts now in Australia, probably more to come. Is that going to keep supporting the housing market? I don't think so, with the economy going through this tough time.
Well, now, the latest core logic data show significant rises in home prices. I have to tell you that some of the other metrics that are coming out from other organizations are not as strong as the core logic ones. So that's the first thing to say. And specifically, we know that movements are actually isolated to some particular postcodes. But nevertheless, there's been a bit of an uptick, particularly more affluent household postcodes, particularly larger property values. So that's part of the story. But yeah, the question now is what's going to happen? Because we know that the leading indicators in terms of intention to transact has dropped off over the last 2 or 3 weeks. We also know that the auction clearance rates were pretty strong over the last few weeks. So it'll be very interesting to see whether, in fact, confidence erodes. And if confidence erodes, transaction volumes could fall. Listings have been quite strong recently. That's another point. But again, we might see listings begin to ease. So I think this is an important indicator because, of course, as I often say, everybody, the Treasury, the Reserve Bank, is banking on the housing sector creating wealth, creating incentives for people to actually spend more. But there's so many countervailing forces now that maybe that's not going to work. So I wouldn't be surprised to see prices beginning to fall off.
No, and I mean, the RBA are between that rock and a hard place with rates. They've only got one more cut left in the chamber that they've promised. And because of that target range, they're effectively at zero if they have another cut. Then they've spoken about QE. Maybe we'll do an episode in future, Martin, because Australian QE is going to look different to US-style QE because of the way that our bond market works, which I'd love to chat to you about in future. But I think they've also got this problem on their hands that if they cut rates again and the economy is weakening, we see all these metrics, unemployment ticking up, what happens if house prices keep going up and it becomes very clear that it's the wealthy that have got all these assets, they can now get more loans, and they're just increasing their property portfolios and everyone else is just getting priced out of the market? That's a big headache if that happens.
Well, my own view on that is that the APRA changes, which basically has allowed the lending tap to open, was a massive mistake. Because what it does mean is that those who can afford to get mortgages and can afford to pay the bigger, because they've got bigger incomes, are actually driving the market higher. But that's leaving a lot of other people stranded. And if the Reserve Bank does cut rates again, as probably they will, as they reach lower bounds, that's just going to have a continued momentum forward in terms of some sectors of the property market. APRA made a mistake, in my view. Well, it probably was a deliberate mistake because they needed to stimulate the market, but it's actually proving to be a really big problem. I think that we've got to see some further intervention in terms of dialing back some of that latitude that the banks have at the moment. Don't think we'll see it, but they should do that. The other point to make is uncertainty. So we know now that rate cuts don't necessarily translate to markets being positive, right? If you think about what's happened with regard to the stock markets over the last couple of weeks, and particularly with the Fed cutting its rates by 50 basis points a couple of days ago, surprise? No, it wasn't surprise. That was expected. We've seen the Reserve Bank cut. People are beginning to wake up to the fact that cutting rates is not a sign of a buoyant economy. It's a sign of problems and issues, right? And that's the key point I want to make, that actually cutting rates is a sign of weakness. It's a sign of concern. And we are running to the point now where we've got to the point where rates are so low that cutting rates hardly has any real impact, firstly. And secondly, it means that the Reserve Bank is going to have to move to quantitative easing. That's going to be a big deal if they start doing that. And all the experience from around the world is that quantitative easing takes you in one direction, doesn't actually support the economy. Look at Europe, look at Japan. And frankly, I think our Reserve Bank is not doing us any favors by taking us down this road.
Yeah, it was literally last month where Jerome Powell said that there's going to be no more rate cuts this year, and he continued his track record of all, Fed chairmen have been wrong every time. And I think they scared the market, and the market goes, oh, geez, 50 basis points. The only time you've done that was during the GFC, during the dot-com bubble. What do you guys know that we don't know? Last month you were saying no more cuts, and I think it really scared the market.
Well, it's interesting that there was a concerted strategy from amongst central bankers to come out and say, we will do whatever we need to do to support the markets, right? What they were really saying was, we will do whatever we need to do to try and support the stock market. So they are thinking about this very, very narrowly. They're trying to keep the stock markets up in bubbly territory where it's been for some little while. It hasn't worked, right? So if you look at the Dow, in fact, the latest data today shows it dropped more than 3% yesterday, and it's been very volatile over the last few days. We're still more than 10% down, which is in correction territory. Could turn into a bear market quite quickly. It's also interesting that people now are saying we can't actually model and take account of all the variables in the system at the moment, because we don't know what's happening with regard to the medical issues that are going on. We don't know what's happening with regards to the amount of fiscal support we're going to get. And we know that many companies, because of the supply chain, which are supply side issues rather than demand side issues, mean that we don't actually have any sense of how to value firms. For example, the airline industry came out and said we could see profits down 20%, nearly 190 billion, simply because of the fall in traffic, right? And that's before you start. So if you look across different industry groups, you'll see that many are actually now beginning to put up profit warnings. Even for locally, we had the hearing aid guys come out quite recently and say, well, Cochlear, that their profits are going to be down because of this. We're seeing again and again and again people warning about uncertainty. So you can't take account in the markets of that level of uncertainty, and that's why there's huge volatile movements. And I guess the other point to make is that this has a flow and effect. So, I'm worried about the banking system, right? Because the banking system is reliant on people with loans making those loan repayments. We've already said that small businesses are now starting to struggle. If some of those small businesses are unable to pay the wages that they need to pay, and in fact start to have difficulty with their cash flows, that flows on into the household sector, which essentially means that households will then be in difficulty in terms of paying their mortgages. And so it cascades on. So that's the first set of forces. The second set of forces is liquidity, right? So if the international financial markets start to get caught in some of this stuff that's going on at the moment, as I think it's quite likely, a bit like the GFC, it was liquidity between banks that started to get into issues where funding's actually got more expensive, not less expensive, despite all the rate cutting. So if we start to see some of that, then effectively we could see that banks being pressurized in terms of liquidity, because our banks require support from international financial markets to make their businesses work. We see pressure coming on from households and from businesses unable to pay their mortgages and other loans. And that could start creating a very nasty environment. Stock markets are not going to go up in that environment, but nobody knows how far down. Nobody knows how long this is going to go on for. So basically the markets are saying, we don't know, expect huge volatility. Final point on this one, computer trading is such a large part now of the major markets around the world. So if the markets start to move in one direction, that movement is reinforced by massive amounts of computer generated trading. Yeah. Ditto if it falls. And so we should expect to see significant up and down movements, so very high volatile movements, and the volatility index in the US is up at 40 again, which is pretty high. And that just shows you that the computer trading systems that we've now got in the interconnected financial markets is creating huge amounts of uncertainty. These markets are not going to settle down anytime soon. My own view is they probably will go low before they go high.
Yeah, so the estimates are between 70 and 90% of trading is now computers and algorithms, and the majority of those, as you say, are trend following algorithms. So if the trend goes down, they're going to reinforce that move to the downside as well. They're going to pull away that liquidity. That's why we see these flash crashes. And in terms of the banks needing liquidity, the Federal Reserve said they were going to taper those repo operations. Sure enough, this week there was $100 billion oversubscribed. The banks need that liquidity again, and the Fed are going to have to do a backflip. Once again, they were wrong.
Yeah, so the Federal Reserve has already put 600 billion more into their coffers, in other words, liquidity, right? And that's through the repo operations and buying treasury bills. They were hoping to taper that down. If they won't, they'll have to keep going. We are in a situation now where central banks around the world are going to be forced to put more liquidity in the markets to try and support the stock markets. That's not the real world, though. And that's my concern. So basically, the more that they throw funds at the stock markets, the more the real economy gets crushed, the more that real households get crushed. So this is actually now getting to the point where I think we need to question whether the central bank policies of the last decade plus make any sense at all. And my own view is they probably don't.
We've just spoken about the markets in depth there, Martin. Is there anything else you wanted to add here? I know a lot of money is rotating into bonds for that safe haven, but anything to add from you?
No, I think only it's interesting to watch what's happened with gold and even, the cryptos. So there's some interesting questions about what's the relationship between what's happening in the stock market and the bond market and some of the other markets. Just bear in mind, a lot of people who hold gold hold it in terms of derivatives. And so we're seeing a lot of volatility in the derivative markets, and that's having an impact on the gold. I think it's a bit the same in crypto land, although I actually also think that cryptos are a bit disconnected, if you like, from the other markets because of the way that people think about cryptos. But, there is really, my view, no real safe haven anywhere at the moment. So pretty much any asset class, whether you want to look at stocks or bonds or, gold or crypto, there are risks in every market at the moment.
Yeah, just quickly, my view is that everything sold off in the liquidity crunch the other day when everyone was getting margin calls, the same as what happened in the GFC. Now it's up to gold and Bitcoin, if it wants to prove itself to be a safe haven like bonds. So we're waiting to see how that plays out. Signs of global trade slowing, Martin. We have touched on this. World Container Index. We touched on PMIs as well. Anything to add here?
Well, just to make the point, this is one of those leading indicators, right? And I think the fact that the global container movements are so down, and we also know that now containers are in the wrong place. So refrigerated containers aren't in the right place anymore. So we're finding that that's a significant issue. And remember that it takes, not just a few days, but several weeks to get from one side of the world to the other side of the world on a shipping line. So if you've got containers in the wrong place, and then even if things start to become a little bit better, it's going to take a long time for the flows of trade to start picking up. So again, this is not going to be a V-shaped, quick down and quick up, in my view. We don't know where the bottom is. We don't know how long this is going to go on for. But I think we've got to assume that this is going to be a long, slow grind. It's going to take a long time to be able to get to anything like right off the back of it.
And finally, Martin, you've updated your scenarios a little bit here. So what is your base case? What are you looking at now?
Yeah, so look, what I've done, I've tried to take account of all the things that I've been thinking about with regards to the recent movements and the recent medical issues, all those things. My base case is that assuming that this thing really becomes more than just a regional issue, so we're seeing significant global disruption, significant issues with regard to the markets. This could well be the trigger. I always say, as you know, that home prices are ultimately 40% over fundamental values. There's no reason why we wouldn't see that correction start to come in. So over the next couple of years, my expectation is that more likely, 50% likelihood, we're going to see prices down, 30% from the peaks that they were. Now, it may be not like that. There are other scenarios that I could go through, but my base case is now looking pretty worrying. And of course, those people who bought recently, particularly property, when they thought prices were on the way up, this is a classic bull trap in my view, and I suspect a number of those are going to find it very difficult over the next 2 or 3 years. Could be wrong. I'll update the models as more information comes through. There are so many levels of uncertainty at the moment, but that's why I do scenarios. But to me, there is definitely a downside risk to property at the moment.
All right, so guys, I do want to put my pharmacist coat back on for a bit and talk about the coronavirus. So that's it for the slides, for those of you that want to tune out now. But a few things that I want to mention for people at home. I don't quite understand the panic buying of toilet paper. If people wanted to stock up, I'd be thinking it was food. And, are we to that point yet where it's necessary to panic that much? I'm not sure. Pharmacies and supply chains are sold out of hand wash. You can make your own at home with some aloe vera and some methanol, anything with high alcohol content will do to clean your hands. But soap and water does work okay as well. So yeah, just don't panic. There are ways to keep yourself safe with these homemade remedies. In terms of the health, the crisis, the side of things, the virus, a lot of people are still saying, oh, this is just no worse than the flu. In symptoms-wise, that might be true, and I don't expect it to really affect healthy populations, but it is going to affect elderly people, those that are immunosuppressed. It's so contagious. That is the thing that is worrying, not the symptoms necessarily. It's the fact that it spreads 20 times more easily than the flu, and it has a long survival rate on surfaces. So this thing can continue to circulate, and I do think that it is going to affect the majority of our population. And we're sort of in this silent period at the moment because we're not doing a lot of testing in places like the US. So it can be circulating in the community, and we're kind of gone from these examples of a few cases here and there. The next step is to see a few clusters where you see the 50 staff have to go home, and then you find out that 5 of them have got it. And then all of a sudden we can get to that parabolic phase where we start to see hundreds or thousands of cases. And I'm happy to say that I think that is definitely coming in the next few weeks.
Yeah, I think you're right. We're at a very early stage here in Australia. I notice also places like the UK, right, who are beginning to take more significant measures. And of course, understand that there's a political line that doesn't want to panic everybody. They don't want to actually, put too much information out too quickly. And in fact, even in the recent Treasury discussions for Senate estimates, they said they don't want to mention too much about how this could play out yet because they don't want to worry the public, right? So there's a real balance there between saying everything's fine, don't worry, just carry on, and trying to actually provide some level of information. Now, clearly there are lots of silly rumors around and lots of panic around. I don't think there's any reason to panic, but I think we need to be a little bit cautious about how this plays out. I think we've got to assume that it is going to get into the general population. We are going to see this definitely quite widespread. And that is why I don't believe this is going to be V-shaped. This is going to be a long, slow grind over a number of months. There are sensible precautions that people could take. I don't think grabbing a lot of loo paper is part of the solution, frankly, but, it's interesting. People want to try and get in control in some way, and that's one area that they perhaps can. But I think we need to watch this quite carefully because the economic fallout and the implications, both in terms of demography and in terms of the health system and in terms of the broader economy, I think are quite uncertain as yet. But lots to watch, I guess, as we go ahead.
Yeah, I guess the message for home for people saying, well, what can I do? It's look after yourself. The same thing you do if you want to fight off the flu. Eat really healthy, get some sun, do some exercise, de-stress. All those things help. You can try those natural things. Some people swear by, chilies, the garlics when they get sick, vitamin C's. Everyone's got their own things that they think help, but it is the thing that worries me today. The Italian hospitals authorities put out a notice saying that up to 10% of the cases, the admissions they've seen of coronavirus are now turning into ICU, and we don't have a lot of ICU beds in hospitals. So this is something that can attack multiple organs. It's not just the lungs. I definitely think that people need to start acknowledging that this is worse than the flu. Nothing to panic about necessarily just yet, but it does have the potential to get a lot worse.
Yeah, I think be alert, not alarmed is probably about the right message at the moment.
Absolutely. So once again, guys, thank you. Please share this around. YouTube's not going to like this video of ours. We appreciate you guys tuning in. Look forward to reading the comments below, and we'll talk to you again next month, Martin.
Good to talk to you. Take care.
Thanks, guys.